My next guest is optimistic, saying it's increasingly likely that October marked the low and we're entering a new bull market, even if it's a timid one. Joining me is Jurrien Timmer, Director of Global Macro at Fidelity Investments. It's great to see you, Jurrien. And, in light of the weakening sort of macro backdrop, if we want to call it that we were just discussing, what do your observations about the market tell us?
Well, the market has gotten impatient, right? We've all been waiting for that other shoe to drop, whether it was, the recession or, the drawdown in liquidity as the Treasury replenishes its cash balance at the Fed. And, the market's now been in a state of limbo, if you will, for about 18 months, right? The peak was early January of 2022. And that, of course, followed a mini bubble, during 2021 when the Fed pushed rates way, way down and kept them there for a long time. That did create an asset bubble. It did elevate the market sort of above its trend channel. And so it's good that we fell back into it. But 18 months is a long time, 10 months of declining and then another 8 months of just sitting around doing nothing. And the market has been in a trading range now for a year, right? June of last year was that momentum low, and then October was the final low. And so I think the market's just getting impatient. You see the earnings estimates are actually starting to improve. The revisions are starting to, get better now. And 2024, the estimates could be all wrong, of course, but the consensus estimate is now for about an 11% gain in 2024. And the Fed, of course, is not done yet. Well, we certainly got the message loud and clear in the last couple of days. But with the Fed at 5.25%, presumably going to 5.5% or even 5.75%, and if we think about the neutral rate being somewhere around 3.5%, the Fed is reasonably above neutral or reasonably restrictive. That I do think we're getting closer to the end of the cycle than the beginning, which is safe to say because we've already seen 500 basis points of increases. So I think the market is just starting to look ahead, and the market always looks ahead, right? Not always correctly, of course, but it does always look ahead, and I think it's playing the soft landing card, and we have to just see if that's the right card to play.
But what would tell you that this is a new bull market versus just a rally within a bear market that will resume once we figure out maybe what exactly the data 6 months from now is going to look like?
So I had been on the fence for a while just because the leadership in the market was very, very narrow. And we all know about, the mega cap tech names, the FANGs, the AI theme. So it's been a very narrow market, which is not something you would see in an early cycle bull market, right? Typically what happens is you have a bear market. Part of it is a reset in rates as the Fed raises the cost of capital. We certainly got that last year. And then the other part usually is sort of a flush in earnings where all the earnings estimates just start to come down. And then that washes out economically sensitive stocks, interest rate sensitive stocks, anything that was kind of driven by liquidity. And we've seen part of that. We had the bank stocks a few months ago. We had the meme stocks a year ago, but we haven't really seen that capitulation and then that broadening rally, that breadth thrust that we tend to see. It's starting to improve now, like small caps, mid caps are starting to improve. The S&P 500 equal weighted index is starting to look a lot better. But we don't have that confirmation yet, and that's something that I would be looking for. And of course, many have pointed out markets up 20% from the low. I don't really follow that as an arbitrary guideline. But what I do know from studying history is that bear market rallies don't tend to retrace more than half the preceding decline, maybe 60%. And the S&P 500 cap-weighted index has retraced about 64%. The equal weight, not as much, maybe about half. So we're still not quite there yet, but we're getting closer to the point where it's really hard to call this a bear market rally. And then the only other thing we can call it, other than a bull market, is just a prolonged trading range. And we haven't had many of those that are this long. The one exception is the second half of the 1940s, which actually is an analog that I've looked at quite a bit in the last couple of years.
Sure, and we've heard about that as well, saying, well, we can go into that another time, but your point is taken. Jurrien, thanks for joining us today, making the case.